Hi, this is Pat with Energy Solution Partners sharing with you our energy market view on Thursday, February 20th. Keep in mind there is a risk of loss when trading commodity futures and options. Also, past results are not necessarily indicative of future results. I want to start out a commentary today just by saying right from the start here that we're really middle of the road here right now with where the market goes from here. We've had a pretty nice run here over the last couple of weeks, and our overall thought right now is more about risk management. And as far as any future activity, really depends on your individual position. So I guess keep in mind where your position is. If anybody is in a long position, I'd probably look at taking some profits here on some of that length, but I definitely would not work into a short position. And at the same token, if you are short, if you've got gallons sold by contract that you don't have covered, I still would probably buy those up and work into a neutral position. I'm going to spend a lot of my time today talking more on the technical picture, I guess, looking at charts and so forth. But just a couple items here from the fundamental standpoint. We want to follow up on the refinery utilization that we have shared before. Kind of a busy chart here, but today's refinery utilization, we're sitting at 86.8% capacity, which is a pretty big number for this time of year. We typically watch these refineries slow down this time of year as they go into maintenance cycles, and we've seen some of that here to start 2014. But the last few weeks here, we've just been treading water, and at this 86% utilization rate, that is a full 5% above where we were a year ago. And just from a pure production standpoint, there was 1 million barrels per day more of crude oil going into refineries today than there was at this time last year. So a lot of product being cranked out yet. Along with that product being cranked out, we've talked about the low distillate inventory. We still are at some low inventory levels, but it has moderated here in the last couple of weeks' inventory reports. We've seen the inventory levels move sideways. The big drawdowns have stopped, but the only reason we're seeing that sideways movement is because of the refinery utilization and the way they're still cranking product out. So those are a couple things we're going to continue to monitor here as we go forward. Not needing to hit any panic buttons here at all right now, but just something that we're going to monitor and we'll continue to talk about. Now, as we view the trading contracts here on the diesel contract, as we rolled out of January into February, we actually rolled from the February futures that we were trading here on the last day of January to the March contract that started trading the 1st of February. And again, we had talked about this. We had a full 25-cent decrease in price between those two contracts, which left this gap in the chart here that we fully expected to fill that gap as we came through the month of February here. And again, this is the March futures contract that we're trading. We have worked that market higher as we expected. We have not fully filled that gap yet. We need to get up into this level to finish filling that. We're only a penny and a half away from doing that. And maybe by the time you listen to these comments on Friday, we may have already filled that gap. So we did come higher as expected. Looks like we're going to fill this gap. And beyond that, I guess I would start to get a little cautious where we go from here. Pretty impressive rally in just a couple weeks' time here. We have ran up over 20 cents a gallon here since the 1st of February. For those of you that did put the call option in place that we had spoke about, that worked out very well here as we did see this rally as we expected. I think most of these call options we have cashed out of and have taken some gain. But for anybody that's got any positions left there, we should probably take a look at that, as I guess our upside expectations are pretty well exhausted here, and time to take some money off the table. But looking forward, we are seeing the same type of setup potentially as we roll from the March contract to the April contract, and we'll have to continue to monitor this next week as we still have a full week of trade left in the March contract. But as of today, the April settlement closed at 308.34 on the April futures, where March settled at 317.77. So we have a full 9 cents of backwardation between those two contracts. And if we were to roll over today based on those prices, that April would be right down here. So again, the potential we might leave another gap in this chart again. And again, something we'll monitor next week. We got time to watch this, but just kind of setting you up for another potential recommendation, I guess, similar to what we had done as we moved into February. On the forward curve chart, we still continue to watch this backwardation, and the front month still garnering a big premium over where these outer months are trading. Again, we're at 9.5 cents of backwardation just from the March contract to the April contract. So when the calendar flips here in a little over a week, just because the outer months today are sitting at almost a dime below the current month, I would not expect your rack prices to drop a dime when the calendar flips. More than likely, we'll see some basis increase, and some of this spread might start to close between now and then. But something we'll continue to watch, I guess, and kind of goes along with our thought process here on maybe some call option strategies that we'll want to put in place again as the calendar rolls. But again, just pointing that out, something we're going to continue to monitor. Nothing we want to do with it today. We'll take a quick look now at the gasoline chart here, and a couple items I want to point out. Seen some interesting trade today, I guess, that I want to share with you, and we did run up above the previous highs that we've seen back here in December, but we did settle back down below those levels, and we'll be watching that on Friday's trade now, and we need to see this close above the December 26 levels here, and if that doesn't happen, it's going to look like a double top on the chart, which would look like a little correction that's in store here. And again, wouldn't be any surprise here to see that with the run-up that we've had. We have rallied since 1st of February here, 25 cents a gallon. So that's one item that we will be focusing on Friday. The other item I wanted to point out here, and I think I've shared this in the past, the gap that we left in the chart here when we rolled from the September futures, from the summer spec product to the winter. Again, we always like to fill those gaps, and it's been a target that we move this gas market higher to fill that gap. But does that mean that we need to go from today's 284 level up to 294 to fill that gap? And that's not necessarily the case, because as we look at the April RBOB futures, we are trading at 303 a gallon here. So when the calendar flips, if we don't fill the gap by the end of February here, when the calendar flips, we're going to have that gap filled just because of the jump in pricing. Again, that's due from the switch from winter spec product to the summer spec, which is carrying a higher price. The other item is the stochastics here. We have moved into an overbought position, so that tells me we are ripe for a little pullback here, some sort of sell-off. But it doesn't mean that it has to happen immediately either. When we see this overbought position, it can sit here for a week or two. That's not uncommon. So we'll be watching these few features here, I guess, on the gasoline chart, and especially in Friday's trade. I want to show you now a weekly chart of the RBOB gas contract, and the difference between the weekly and the daily chart, the longer the length of time, the more meaning the chart supposedly has to these technical traders. Just like a monthly chart would have more meaning than the weekly chart. We don't look at monthly charts very often because a monthly chart, it takes 3 or 4 or 5 months to watch the chart patterns develop. And most of the time, we don't have 4 or 5 months to wait for the chart pattern to develop to decide what position we're going to be in. We're in and out much quicker than that. But the points I wanted to make out on the weekly chart here, going back to where the gasoline topped out at in 2012, and since that time, each time we've gone down and come back higher, it's been a lower high. So that leaves us with a downtrend in this chart, and which I have drawn in the blue line here. And so now as we approach this $3 mark, we are trading at those levels here in the April contract already. So we're going to keep an eye on that and see how that develops, especially after the calendar flips here in a little over a week, and see if that downtrend stays intact. Or if we do break through it, then I guess it could open to the door to a lot more upside here. But something we'll want to keep an eye out for as we go forward here. And as long as I have this chart up here, I'll just share with you where we peaked at in the preseason run up here, going back to 2011. That peak took place in the last week of April. 2012, when we peaked and then came down, that was in the third week of March. And then last year's peak happened in the first week of March. So the seasonality, we have the preseason run up, and we peak really before the driving season starts, pull back, kind of regroup, and then reload for the second half of summer. I guess I won't expect anything a whole lot different for this year, so we'll watch those. The other item, the stochastics on the monthly or on the weekly chart, is just starting to move into the overbought position. We're not completely there yet, so we do have a little time to watch that, and would expect that to push higher yet and move that more into an overbought position before we are ripe for that sell-off. So a few things we'll point out there. So with that, again, I guess I just want to emphasize how important it is to keep your position square at these levels. We've been touting a higher market here for some time and recommending long positions, and now we're scaling back from that. We have had a nice run up. We think it's a great time to take some profit if you do have some long positions in place. But it's a good time to review your overall position with the contracts that you have bought or sold here. We would love to visit with you about your individual needs. Feel free to give us a call and we can visit. Thanks for listening.